Great. Thank you. It's fantastic to be here. Obviously, we are all here for FinTech. But as I look around kind of the attendee list, what I don't see is a lot of people working in the place I work every day, which is emerging markets. So I thought I would use this session to give an overview of our place at Lendable, which is emerging markets FinTech, walking through the landscape of how we see emerging markets FinTech, what's happening now in terms of the macro headwinds we see globally and the funding environment changes, and how that's impacting FinTech borrowers that we have and their portfolios using data that Lendable takes. So in terms of who Lendable is, to just give you a frame of where I come from. So Lendable provides debt to FinTechs, specifically in emerging markets, to help them grow. We focus on this space, this sector, these geographies for a couple of reasons. One is we believe in the mission of providing expanded financial access for underserved populations globally. We also believe in the commercial opportunity that FinTech provides in these markets. And so we were founded about 8 years ago, originally out of Nairobi, but now we've expanded to global mandates, offering capital to this sector. So in terms of where we work, so I talk about emerging markets. We work in some specific markets within that space. So about 45% of our portfolios in Africa, and this covers South, East, West, North Africa, so all the corners. About 45% in Southeast Asia. This is Indonesia, the Philippines, Singapore, Vietnam, Thailand. We're actually in South Asia as well with a transaction in Bangladesh. And then the rest of the portfolios in Latin America, which is right now fairly small for us, but is growing as we've shifted a lot of focus towards that. I want to call out a couple stats about these regions. So from a population perspective, these regions account for over 2 billion people. So this is a quarter of the global populations here. From a GDP perspective, it's over 12 trillion, which is about 10% of global GDP. So obviously you see some disconnect there, right? So it's quite large from a population perspective, but right now, from a financial perspective, it's much smaller. But there is quite a lot of opportunity from both a FinTech, a financial inclusion angle. As we talk about that first point around Lendable's mission around need, when we look at this map, the darker the shade is, the higher the penetration of financial access, really measured by financial accounts. And so we see, I'm going to generalize a little bit because we're talking about a lot of different countries within 3 major regions. But on average, the financial account access in our markets is about 50%. So there's 50% of adults who don't have financial access. We do see some places where there's difference. So Thailand has 95% financial access in terms of account penetration. We see progress. So we see mobile payments or digital payments increasing from about 35% in our markets in 2014 to 57% in 2021. So we see progress. But by and large, there's a lot of work to be done. And this is a need. So this is a demand driver, but also provides a lot of opportunities for FinTechs. In terms of the infrastructure that builds it, I think what's really important for us to understand is connectivity. So this next chart, which is put out by the GSMA, which monitors kind of mobile access, talks about our regions and both coverage from a mobile perspective as well as connections. And so what we're really looking at is Asia being fairly well covered. On the other hand, sub-Saharan Africa having a lot of gaps, both in coverage, but certainly in kind of connections. That said, even when you have access, it doesn't mean there's always a good fit, right? And so there's going to be a disconnect where people have phones and they don't have financial services. And so why is that? So here's data pulled out by the Global Fintechs database. There's a lot of research in this space, talking about kind of the main reasons that 50% of people who don't have an account, why is it? The biggest one is lack of capital to put into accounts. That's one that FinTech is often going to have a hard time filling. They're going to be able to provide capital. Though we did see during COVID, for instance, a lot of governments putting stimulus payments into the populations, but using tech to transfer that. And so using digital payments. And this was actually a really powerful way to bring individuals to accounts by making them go to the digital realm to receive their stimulus payments. But that said, you look at a number of other reasons, that fintechs can address. So the second highest reason here is it's just too expensive. And if you look at markets like Mexico or Brazil, and you gauge return on equity for banks in those countries, the average return on equity is about 18%. That's double the return on equity of banks in the US and about 5 times that in France. So this provides a couple things that are impactful here. One is banks have little incentive to change the status quo. So they haven't changed pricings, they haven't had to innovate, they haven't had to reach new customers because they have it pretty good. But it also provides a huge opportunity for disintermediation from new entrants, which are often fintechs, right? And you can see this new bank is the largest digital bank in Latin America. It's one of the largest digital banks in the world. It's out of Brazil. They have 50 million customers. And part of it is addressing this challenge where there's just a disconnect in terms of providing affordable financial access to underserved customers. And so we see this as a real driver of opportunity, right, in terms of the solutions we support. Going to the next slide. So I want to go back to that point of connectivity. So even when you have a smartphone, there's still a lot of opportunity to provide financial accounts. You look at sub-Saharan Africa and South Asia, about 50% of the people who have mobile phones still don't have financial accounts. So when you think about fintech really using that connectivity as a driver for growth, that opportunity is still there, right? And that's the opportunity that we see every day, these underlying fundamental demand drivers pushing the sector ahead. Turning to where we do see mobile money progress, this chart looks at the amount of accounts that held in mobile money. So a key point here is if you go back to 2012, 10 years ago, sub-Saharan Africa made up most of the emerging market world's mobile account holdings. This is a big driver. If you guys don't know the story of M-Pesa in Kenya, M-Pesa was a product rolled out by the large telecom called Safaricom in Kenya, originally in 2007. Right? And they said, we want to be able to enable peer-to-peer transfers digitally so you could send money up country to the countryside without having to deliver it in cash from a highly cash-based economy. And very quickly, it was adopted throughout the country, and now it's incredibly prevalent. So over 90% of the population has an M-Pesa account, has a mobile money account, and transferred money digitally. But as we've seen, sub-Saharan Africa over time has become less of a portion of the global mobile money holders. That said, that's more because the others have really started to grow. But it still drives about 50% of the account ownership and 70% of the volumes. So it's still a huge driver, and a lot of it's built off of this idea of mobile money really taking root in a number of countries in sub-Saharan Africa. And that's depicted here. Again, the darker the shade, the more penetration of mobile money accounts. So going back to 2014, those dark ones in East Africa, Kenya is the darkest in the core there, but we've seen it progress over time in terms of penetration. And again, one of the reasons we chose as our original market sub-Saharan Africa because of the fintech opportunity that builds on the back of this. One of the things that the World Bank has studied is the usage of digital cash, so being able to receive a payment, and the way that catalyzes other digital financial services. So it's effectively the jumping point into savings, into lending, into sending money. And so this is kind of the root that underlies a lot of the additional fintech opportunity in the markets. When we step back and look at those cash transactions globally, we actually see that Asia accounts for the most globally, right? And it's still continuing to grow at a high rate, 25% a year. It's quite large. On the other hand, places like Latin America still lag behind. So fairly low growth rates, fairly low digital transactions, highly cash-based. Though there are examples that demonstrate how quickly things can change. So in 2020, in Brazil, the central bank introduced instant real-time digital settlement through PIX, which you can scan a QR code, send money, pay for a good. Within 18 months, 2/3 of the adult population were using PIX, and within 2 years, PIX was used as much as cash in the country. So incredible adoption when it was implemented through a really innovative, useful, easy to use product. And that's what we see kind of maybe not as an extreme case as quick, but that opportunity in a lot of other markets as well. In terms of leveraging cashless payments into other fintech subsectors, stepping back and looking at Asia, we can see that lending is continuing to be one of the biggest segments and one of the fastest growing sub-areas of fintech. This table is out of a report put out by Bain, Temasek, and Google. It's from 2021, but they actually just this week released the 2022 report. And they note that the digital economy is on target to hit 200 billion of gross market value, or gross GMV, gross merchandise value, this year, which is 3 years ahead than the projections they just laid out in 2016. So there's a lot of pace growth in terms of the usage of digital financial services. And looking at as well, going to the Africa perspective, we see similar. So historically, lending has been the root of kind of non-just transaction or non-payments fintech. But we see a lot of growth not coming from lending anymore, but coming from payments, coming from wallets. Obviously here they see a lot of opportunity in the blockchain and crypto space, but it's growing from a very small base. But we're seeing a lot of kind of diversification of what was originally just a wallet or just a payment. Now let's talk about the funding flow. So obviously, everyone who's familiar with kind of the venture ecosystem in the UK and Europe and the US knows what's happened over the last year. The same has happened effectively in emerging markets. This is a very busy chart, so I apologize for that. But what I'm trying to call out is ex-China, so let's set aside China VC, emerging markets are still very small as a portion of global venture capital. And this is the allocation of private capital into geographic markets. But that said, it has caught a lot of the tailwinds from the overall growth of investment over the last several years. In terms of what's happened in 2022, so for the first half of the year, everywhere was hit, except for oddly Africa, which had huge increases of investment in the first half of the year. But if you look at Latin America, if you look at Asia, it's what happened to every market, right? Got crushed, funding slowed down. And so we originally thought, okay, maybe Africa's a little bit resilient. Maybe there's a different dynamic going on, smaller tickets, more diversification, investors keep coming. The reality is the Q3 numbers came out and it dropped off a cliff for Africa as well. And so this is something that fintechs are dealing with there as well, is really, when you think about VCs pulling it back, a lot of that from international investors is going to a fight to quality, and that's often a fight to what you know. And so you see a lot of the international investors pulling back from places which are more kind of emerging to them, newer to them. But that said, I think one thing to note here, while it's dropped significantly in sub-Saharan Africa in Q3, it's still the second largest quarter if you look at any time before the second half of 2021. So it's still large. It's still gained a lot of momentum, but it's just dropped from a significant recent high. Now, we obviously are influenced at Lendable in our investments in these markets by what's happening in a macroeconomics view. And so I'm just going to take a moment here to talk about that at a very high level, but we can talk about some regional themes as part of this. So in Asia, we actually saw very slow increases of inflation earlier this year, not a lot of impact. In the last 2-3 months, that's changed. We're seeing a lot more inflation. We're seeing central banks step in, raise rate. But on balance, this is kind of one of the healthiest macroeconomic markets globally. And not just in emerging markets. If you look at against certainly the UK, a lot of European markets, the US, then the markets are managing a bit better. And so we continue to be very optimistic about Asia. They also are large companies or large countries with relatively deep capital markets, so the capital keeps flowing. Though for earlier stage fintechs, it can be a bit more difficult. When you go to Africa, one last point on Asia, which is in South Asia, there's been some particular challenges. So Sri Lanka defaulted on debts. Pakistan and Bangladesh are seeing real macro and fiscal related issues. And so there are things that you need to watch out for, but Southeast Asia separately is doing fairly well. Africa, specific countries have stress that make countries almost uninvestable. So Egypt just reached a deal with the IMF earlier this week, but until then the currency's dropped against the US dollar by 60% this year. Ghana has seen even worse troubles. Nigeria has US dollar liquidity issues. So it makes it very difficult for a foreign lender to come into some of these markets. Though if you look at East and Southern Africa, they've had signs of stress, but they tend to be doing pretty well. And then from Latin America, interestingly, they've seen historically very high inflations, and so they were a bit ahead of the game here. Brazil, which had one of the cheapest costs of funding at the central bank level, the Fed funds level, in emerging markets, they were down at 2% back in kind of 2020. They raised their rates all the way to 14% within 18 months. Now, obviously, that puts a lot of stress on the local economy, on the cost of funds for banks and fintechs, but on the backside, it puts the country in a lot more stable position. They're even at a point where they're almost talking about rate decreases. So they're ahead of the curve. Mexico is very similar, and they also avoided a lot of the stimulus during COVID that led to some of the inflation that we've seen. That said, Mexico's tied very closely to the economy of the US, so we expect them to be dragged down a bit there as well. And we've also seen a lot of elections over the last year and a half in Latin America, and this has put into place, I think, just uncertainty on the political standpoint about how these new regimes are going to impact foreign investment, private sector, and then the regulatory environment around fintech. In terms of how this translates into what we see at Lendable, so stepping back into what we do, so when we think about the sub-segments that we're focused on, it's really fintech lenders, so those who lend to small businesses, to consumers, or against assets. We work with digital payment platforms, so those moving money digitally. We typically finance them if they're moving money across borders. And then embedded finance platforms. And over the years, we've looked at over 80 million loans. We've looked at millions of payment transactions. And we have over 4 billion data points that we use. And this is really used to inform how we think and how we analyze risk in these markets, assessing that and understanding these themes. And so we can use this basis as a way to think about the impacts these macro challenges, the looming recessions, will have on the fintech portfolios more widely, right? And so one of the ways we look at that is around what's happening with their portfolios. Are fintechs growing their portfolios? So the red here is COVID, and the final green is kind of where we're at today, and then with some projections. When we look at originations during COVID, there was a clear acute shock. Originations suddenly dropped. This was done for a couple of reasons. One is that the fintechs were proactively shutting off the pipeline. Let's close down the book or let's lower originations because we don't know what's going to happen. Another is demand-driven. So fintechs saw risks in the market, and so they pulled back. In 2022, beginning really in January this year, we saw a material slowdown, not on an acute level, but the trajectory of originations slowing quite firmly. And we think that's going to continue. And there's a couple reasons for this in terms of risk management that we'll talk about in a couple slides. But certainly, the kind of really good times of portfolio growth is starting to sway. We'll see how that plays out as things move forward. But we're seeing fintechs be very proactive in a different way than from COVID. Another way we look at it is through repayment rates. So these charts show portfolio at risk at 30 days. So effectively, our portfolio risk by 30, which is if you're 30 days late on a payment, at 3 months on book, which represent, let's just call it a young portfolio. So it serves as a leading indicator for us on loss rates. Again, the red is during COVID, and we saw very steep jumps in portfolio deterioration. So when it goes up, when the portfolio is at risk, we're seeing a deteriorating portfolio. But right after COVID, it went down very sharply again. And this is partly due because of the ways companies put in risk mitigation measures. In 2022, we're seeing, again, not in an acute way, but we're seeing increases in portfolio at risk. And this is translating a little bit to increased losses. It's not necessarily steep, but it is very present. Looking at a regional basis, a lot of this, and this goes to originations as well, is coming out of Africa and Latin America, with Southeast Asia being more steady, so not having as big negative impacts both on origination or on portfolio quality. But we are seeing it across the board increase. In terms of how fintechs are mitigating this risk or thinking about portfolio management, there's a couple key things that we see. So one is they've increased the percentage of repeat borrowers in their portfolios. So as you'd probably expect, if you lend to someone once, they pay you back, you lend to them again, they're typically going to be a better borrower, and we 100% see that through the data. And so we saw a little bit during COVID an increase in, and this is the top chart, an increase in the percentage of repeat borrowers as percentage of portfolios. In 2022, this is a jump. So fintechs are shifting their portfolio to the more quality customers. Those who have borrowed before, you've developed a track record with them. The second thing they're doing is they're lowering the average amount of their loans. So we're going to de-risk. We're going to not approve you for as much. We're not going to give much out. We're going to try and diversify more. And this is, sorry, it did not come out very clearly in the numbers below when it was moved to PowerPoint. But 2022, the number of fintechs that we look at that decreased the portfolio size jumped to 54%. So more than half of fintechs were reducing the average loan size in their portfolio, again, for risk management tools. One interesting point, which we haven't seen a lot of yet, that we're starting to see it in the numbers, is the passing on of higher interest rates to end borrowers. And so we haven't seen them necessarily say, okay, it's a riskier market, and so we need to kick up interest rates. We're starting to see that now, but it's been a lagging indicator. The first things fintechs did was really look at their portfolios and say, how do we de-risk? How do we try and prevent deterioration in the view of a looming recession? And then finally, how do we think this plays out in terms of our own portfolio? So this chart looks at loss rates among monthly cohorts for our portfolio. The green line is the actual cohort loss rates. The two spikes in the middle are during COVID. So there was a couple bad months in COVID where if you were originating loans, those loans were more likely to go bad. Interestingly, at the end of the chart in 2022, we haven't seen a lot of jumps in loss rates. But the other point here is the way we analyze data and the way we risk model takes into account stresses on historical loss rates. So we look at historical data, both of the borrower we're looking at, but also using our own kind of analysis and information base to try and project what our stress is in a stressed environment. Are we going to be okay as a lender lending to these fintechs? And both in COVID, and certainly at this point too, we're still well in our comfort zone. And so that while the shocks during COVID were very acute and steep, we were okay. And I think what we're anticipating now is even more comfort from where we're at in terms of the current environment. So we're seeing a slower deterioration, certainly a harder environment for fintechs to be operating, particularly for those who are lending, but not in such a bad way that we don't think it's going to be effectively uninvestable. And so the big takeaway for us is, look, we're going to continue investing. We really believe in the need for financial access in emerging markets. We really believe in the opportunity that these geographies give to fintechs to build a scalable, profitable business model. And we're going to continue being there. That said, there are challenges, and we're very aware. And I think as we look at borrowers, as we look at our potential investees, we want to make sure they're looking at these risks and saying, okay, the environment has changed. It's not 2021 anymore, so we're going to build our business model under the current environment. And these data flows inform how we think about that, and we're continuing to invest into it. So thank you very much. I'm looking forward to answering any questions that you have around this.
Thank you, Suresh. Thank you. Now, backstage, I was saying that the audience so far have not been asking as many questions as I would like, so I'm hoping they're going to prove me wrong and someone's going to put their hand up. If anyone does have a question, please put your hand up. We do have some questions that have come in virtually as well. Don't be shy. Please ask some questions. You touched on Brazil there, and I just wanted to ask you, because obviously there's just been this current change in government over in Brazil. What impact do you think that might have on the situation there?
Let's see. I mean, I think it's the election was just this week.
Yeah.
I think it's a little too early to know. I think we always go into political changes with caution, certainly. We have seen a number of left-leaning governments come into Latin America over the last year and a half. By and large, actually, the rhetoric's been a lot sharper than the actual teeth in terms of impacts on both the private market as well as fintech specifically. And so I think Brazil's made significant progress from a fintech perspective, and so we won't see that dialed back. I think what we'll have to see is how it impacts the overall economy in a fairly turbulent economic space, right? And so I think we're watching it. I don't have conclusions yet, but we're certainly looking very closely, having conversations every day about this.
Okay, appropriately a very diplomatic answer. I like that. Now, I'm sure I saw this on the news this morning that the word of the year, according to the Oxford English Dictionary, is perma-crisis, because we are in a constant state of crisis. So, bearing in mind the last few slides that you showed there and the impact that risk is having on fintech, do you think that fintechs could or should embrace more the current levels of risk that we're living through, rather than losing appetite?
So we're a lender, so we're risk averse by nature. So we don't think so. We think there's opportunity here, certainly, for those who are well positioned to embrace it. I think this is where some weaker players are seeing signs of stress. And I think one of the things we didn't talk a lot about here is the funding environment. So if you're not well positioned on a capital perspective, from a capital perspective, it's going to be harder now to make sure your runway is there. And so this is where those who are well positioned may have opportunity to grow. But we do want our portfolio companies, certainly in the ones we look at, to be conscious of the risk that more capital is not going to be coming very soon necessarily to replace outgoing capital, that there are risks to the book and getting repaid. And I don't necessarily think it's a lean in to risk perspective, but it's certainly one where if you have a solid business with good unit economics and strong kind of liquidity in the business, there's going to be opportunity to grow, and we're going to grow with you.
Okay, last chance for any questions. Yes. Oh, look at the hands shooting up. Okay, we'll just get a microphone down to you. We've got 2 questions here that we'll take from the floor, then I've got one more. If you just start by stating your name and where you're from, please.
Yeah, my name is Nurbal. I am from Orient Swiss SA. So one question regarding interest rates. So what happened to interest rate in 2022, this year?
Yeah.
To the interest rate that you're charging, you're like the company that you're investing, and what's happening to interest rate that the fintech companies are charging their customers. So what is like magnitude? I know it's increased probably, but what is the magnitude?
So we raise our capital out of the US and Europe. And if you look at the rates here, so if you look at SOFR as the benchmark rate, it's gone up 400 basis points this year, from January to now. If you look at the credit spreads for high yield bonds in the US, they've gone up another 200 basis points. So we're talking about really an increase of spread of 600 basis points. We certainly haven't gone up that much, but we have to go up. So one thing we do, we use floating rates in our transactions, so it adjusts somewhat for that benchmark rates. But we certainly price to the borrower into that overall risk profile. That said, they've gone up, certainly not by 600 basis points, but 100, 200 basis points, depending on the borrower. In terms of how they're passing that on to their customers, so not entirely yet. This was kind of one of my last points was we hadn't seen fintechs increasing rates to their borrowers through the first 7 to 8 months of this year. We're starting to see that incrementally now as they're able to reprice contracts or bring on new borrowers at higher rates incrementally. Of course, it all depends on what your borrowers will absorb it also depends on the unit economics you have coming into it. So when we do underwriting, we're looking very closely at the unit economics, understanding what kind of stress they can take within their current product. Is there room to give, and can you absorb that? And so for a lot of them, they're taking it at the balance sheet level effectively through the economics without necessarily passing it on directly.
Okay, thank you. And we'll just take that final question as well. Thank you.
I'm Luis Lancos. I'm for Elevon. All this is very interesting, right? And I actually have a daughter in South America that recently created a FinTech there. Yeah. So I'm acutely aware of all this discussion. I have the question that comes to my mind, and that actually correlated with the previous one, right, is as these markets, you don't have credit rating mechanisms, at least strong credit rate mechanisms, and that support KYC, AML, and all that bunch. How you balance, how you evaluate people, how you balance then the risk, and at the same time present a fair rate, right, interest rate, because if we look at these populations, big interest rates, I don't think they can manage probably, right? So I think there is a balance between the risk and what you can offer in terms of flexibility. So I really wanted to hear the thought.
Yeah, no, absolutely. And I think this goes back to one of the reasons why there's a lot of exclusion of financial services in these countries. When you're not banked, you don't have a financial track record, so it can't be measured. And it's not accessible to credit providers. And so when we think a lot about the fintechs we're working with, a lot use what information is available to them. So whether it's access to mobile money records so you can see transaction flows and getting data out of it, whether it's using alternative means to assess income, we see them implementing kind of credit processes, credit procedures that factor in non-traditional sources. Generally, really, in most of these markets, generally is not a credit bureau. Some, like Mexico or something, you will see credit bureaus used. They've also had to innovate in terms of ways to protect their capital. So we work with providers of financing for cars or motorcycle taxis or for smartphones. And there's a common theme, which is they've developed technology that can either shut off the device or shut off the car, track the car on non-payment, and then allow it to work again once you can pay it, right? And so you have to use innovation to make sure you have incentive to pay you back when you don't have all the information or the feedback loop that a credit bureau provides you in order to encourage repayment. On the fraud KYC, that's a different country level perspective. Some have very good kind of central ID databases. Other countries, you're still having to do manual KYC, checking IDs, because it is difficult. And this is a major pain point. It's really market by market. It has to be solved, right? Everyone has to do KYC. You have to figure it out. And so there's a lot of really innovative, both fintech and non-fintech tech businesses looking to solve this, but it's something that's addressed really at a country level depending on the local circumstances.
Okay, thank you for your questions. Another great session. Thank you so much, Suresh.
Thanks, Scott.
Thank you. Thanks.